Okay, here we go. Okay, so basically, we'll do some questions at the end. There's not going to be a break because this isn't that that involved this time. We probably need a break next week. I just got an email that the 4012s and the 6744s, those are the certification booklets. They were delivered to United Way today. So I'm going to be going down there to see what exactly we got. I'll advise when you can come by and pick them up. Again, for those of you that are new, they look like this. This is the tax Bible. This is what we use to reference any questions we have during the tax season. It's also a great aid in doing the basic and advanced exam. Again, this will be recorded and saved to the website. Some key changes for this year. The tax deadline is Tuesday, April 18th. That's due to the Emancipation Day holiday on Monday, and the 15th being a Saturday. So whether or not we go to our several spots on Tuesday will be up to discussion as we get into the tax season. We probably will have one last day at Salvation Army and maybe United Way as well that night. A couple more changes for the 1040, and I'll show this when we're done with this PowerPoint, that they've added a bunch of lines for additional types of income, almost none of which we will ever see, but it does crowd the 1040 a little bit more. And also on Schedule 1, they've added some more things for excluded income. And we'll get into that as that gets published as well. There are no more recovery rebates. That is gone, so we don't have to ask those questions anymore. The child tax credit is back to what it used to be. There was no advance payment in 2022. It tops out at $2,000 per eligible child, and it is for a chunk of it based on earnings. So it's kind of going back to the way it was in 2020. Many other of the temporary things that came out of the COVID relief bills have expired. The most notable one for us is the upper age limit for the earned income credit is now back to 65. So those folks that were collecting Social Security are in their late 60s and 70s and went and earned $10,000 working somewhere and then qualified for like a $1,000 refund based on the earned income credit, they're not going to get that this year. It's interesting. That's actually a test question on the basic regarding the whole age thing in EITC. And the other thing that is gone is the charitable contribution on the page 1 of the 1040. So in other words, if you made a $300 contribution, you don't get any credit. You have to itemize in order to take your charitable contributions this year. There are some other things out there that don't really impact our clients. Some things they've moved the income limits a little bit, but again, nothing that we have to really focus on. These are the key things that are going to impact our clients, particularly the child tax credit and the earned income credit is going to basically push refunds down pretty substantially. So who must file? These are the numbers. If you make over these numbers, you have to file. Again, we really don't get into situations where people may or may not have to file because almost everybody wants to, because they have withholding and chances are they're going to get a refund. But again, if for some reason someone wants to know whether they have to file and their income is below these numbers, the answer is no. However, if there are other issues that may force them to file, even if their gross income is below those numbers. So if a person, all they made has net earnings from self-employment of $400, they have to file. If that's all they had, even though none of that would be subject to income tax, they still have to file. If they receive the non-qualified distribution from a retirement plan and they owe tax on that, they have to file. The situation there is probably someone who has an IRA, a young person under 59 and a half who cashed in an IRA or a 401k and is subject to, let's say it's just $1,000 they took out. Not going to have to pay tax on that, but you are going to have to pay the 10% penalty for cashing it out early. So you'd have to file a return then. If for some reason the taxpayer owes money related to the basically paying back credits like the education credit or the first-time homebuyer credit, they have to file. We don't see a lot of that. There is one or two folks out there who we've been tracking over the years for the first-time homebuyer credit, but again, not something we see very often. The big one is if they did receive their health care through the exchange and they got the advanced premium tax credit, which lowers their monthly premium. So the IRS last year instituted a sort of a catch-all. Basically, the return gets rejected because if you recall, some of our returnees, the IRS and Health and Human Services share that information. So HHS tells the IRS that this Social Security number got insurance through the marketplace. And so at the end of the year, you have to reconcile that situation with your tax return. Most cases, folks have to, generally will get a little bit more of a refund. Sometimes they have to pay it back, but they do get a 1095-A, and that is, we have to have it. If it gets rejected, the good news is it doesn't get processed. It just kicks back. So then we have to call the client, tell them to get the 1095-A. Sometimes they have no clue. Right now, I think I have 3 still pending from last year, who every couple of months I give them a reminder call that we still haven't filed your return because they didn't get us the 1095-A, and either they're not picking up my call or they're just going to let it go, and who knows what's going to happen. But that's something we do have we had about 25 of those kicked back last year because of this. Okay, who should file? And again, all this information is coming straight out of the 4012 handbook. Again, taxpayers who are below the gross income threshold should file under these kind of circumstances. Basically, they want a refund of the federal tax that was held or paid during the year. It's that simple. Everybody has tax withheld, and generally you won't know if you get a refund unless you file. If you get a 1099-B or a 1099-S, you have to file. All right, you should file because again, there may be tax owed on that. The 1099-S is if you sell your primary residence. We don't see a lot of those. 99.999% of the time, it would not trigger a tax situation. It's just something that needs to be reported for the IRS. Same thing with the 1099-B. That's a sale of stock. And again, if you have little or no income, even if you have capital gains, you probably don't have to pay any tax, but you do have to report it. And that's kind of like, just like last year when we were reporting the stimulus payments, none of that was taxable. However, it was reportable. Also, the only way to get the earned income credit, the additional child tax credit, the refundable American Opportunity Credit, any of the stimulus that they didn't get in 20 or 21. So if they haven't filed in 20 and 21, they can still get the stimulus money. But again, they have to file. And again, my favorite, the senior citizens who are eligible to receive the New Jersey property tax rebate, which is the $50. So folks who are 65 and over, even if they have no taxable income, all they have is Social Security and they pay rent or real estate taxes, they're entitled to a $50 refund. We had, I think, 70 of those last year, which is kind of interesting. Okay, the other thing, something you'll see in tax-wise, they're really cracking down on confirming mailing addresses. I think there was a lot of problems with folks who are kind of on the fringes and haven't filed a lot, that stimulus checks went out to the wrong address. So the tax-wise actually is asking you to confirm their mailing address. Again, it's important to get the right mailing address and indicate, again, if the documents that they're getting, their W-2s, their 1099s, are different than what they report as their current mailing address. That has to be indicated when we do all the processing. And again, there may be other information, particularly on the New Jersey return, in addition to the mailing address, school district codes, things like that. And we'll go over that in January when the New Jersey stuff is live. Okay, dependents. Okay, dependents those are going to claim to get various credits if they're eligible. They cannot claim any dependent if he or the spouse is filing jointly, could be claimed as a dependent by another taxpayer. Okay, the person claimed as a dependent must be either unmarried, or if they're married, they're not filing a joint return, a U.S. citizen, U.S. resident alien, or a U.S. national, or a resident of Canada or Mexico. There's special exceptions for adoption cases of which I've never had to deal with. And the dependent must either be a qualifying child or a qualifying relative. So the issue with the claiming someone as a resident of Canada or Mexico, if you're providing meet the support tests, for instance, a relative, a child of yours, you're providing all that support and they live in Canada or Mexico, you can actually claim them even though they're not a resident of your home. You might see a lot of that, and particularly where it's a mother or where it's a parent, and they're providing support, and they're in another state or they're in Canada or Mexico. Now, the qualifying child has to be the taxpayer's child, stepchild, brother, sister, half-brother, half-sister, stepbrother, sister, descendant, or any descendant of any of them. In other words, a niece or nephew, or a grandchild in this case. An adopted child, an eligible foster child, and they have to be younger than the taxpayer or the spouse, and either under age 19 or a full-time student under the age of 24, or any age if they're totally and permanently disabled. And we see all of those all the time. Okay. It's important that we must know that they live with the taxpayer more than half the year and do not provide more than half of their own support. They do not file a joint return unless they're filing only to claim a refund, and not be a qualifying child for another taxpayer with higher priority under the tiebreaker rules. Now, this gets a little complicated, and knock on wood, we never see this. What really we see is, and the tiebreaker rules really involve a situation where it could be where there's a disagreement over who could actually claim the child. In our world, there's almost no situation like this. What happens is, in this case, here we go. The child, there we go. The child lives with the parent or the custodial parent. They come in with the social. They provide all the information. As part of the intake process, we're asking that you are the custodial parent and that they have lived with you for more than 6 months, and they indicate yes. So that right there, that tells us that there's not an issue with who may or may not be claiming the child, whether the custodial parent or not. Now, it could be the situation where, and I see this in my private practice, I really haven't seen it much with VITA, where parents may alternate as part of their custody agreements, claiming a child 1 year to the next. As long as that's fine between them, that's fine with us. Now, the situation becomes more problematic when someone goes and claims a child that they were not entitled to. Unfortunately, the way the system works is it's first come, first serve. So if someone files a return very early in February and claims a child that they don't, chances are that's going to get processed. And then when we go to file, let's say a month later, it gets rejected because that social has been already used. Then we have a situation where we have to paper file. And then that takes a while to get sorted out on the IRS end. Now, what generally happens is the custodial parent's social will be flagged so that whoever tries to claim that child again gets rejected. I'm currently working on a couple of cases very similar to this through VITA, where we're trying to clear this up. Again, that's not stuff we see, and ideally there's correspondence between the IRS and the taxpayer regarding this. A lot of times, they don't keep it, they don't save it, and it's unclear sometimes as to what the status of their account with the service is relative to the dependent child. Here we go here. Okay, qualifying relative. The qualifying relative must not be the child, taxpayer, or anybody else's qualifying child. They have to live with the taxpayer all year as a member of the household or be related to the taxpayer. the key difference there between relative and child is they got to be with you all year. The qualifying child thing for at least 6 months also kind of helps the idea that a child that is away at school is still, even though they're gone 6 or 9 months, you can still claim. Again, the qualifying relative, again, we're getting, it could be stepbrother, stepsister, father, mother. We see a lot of people that do that. Their parents come in and they claim them. The reality is that a qualifying relative will only entitle the taxpayer to something what's called the other dependent credit, which is a reduction of their tax bill by $500. Again, nothing to sneeze at, but a lot of people don't have taxable income to begin with. So sometimes they fill the intake form with a lot of household information that isn't really relative to their actual tax situation. The important thing about taking a qualifying relative as a dependent is that their gross income has to be less than $4,400, and the taxpayer must provide more than 50% of the person's total support for the year. Again, that gets into, so some maybe mom or dad or grandparents are getting some sort of disability or Social Security in a very modest amount, and that's not nearly half of their support. A filing status. There are 5 filing statuses: single, married joint, married separate, head of household, and qualifying surviving spouse. Single is really what it says it is. You're filing single. You're single if on the last day you are unmarried or legally separated from your spouse under divorce or a separate maintenance decree, and you do not qualify for any other status. Or you were a widower whose spouse died before 2022. You're single unless you remarried, or if you meet the test for qualifying surviving spouse, and that means that you have a dependent child. So the one thing that we see fairly often is on the intake sheet, it doesn't say single, it says never married. So never married and single could be 2 different things, because maybe you were married, now you're not married, or and now you're single because you got a divorce. But what if, and we see this all the time, someone they see the never married, but they were married, maybe they still are, so they check married, and then we interview them and we say, well, where's your husband? Oh, I haven't seen him in 10 years. So what do you do there? You know, there it comes down to the situation where what is the reality of what their situation is? And the reality is they're single. They've just never gone through the process of getting a divorce. So even if we would insist that we try and file, because, well, they're married, you have to do married separate. Well, then we need the spouse's name and we need his Social Security number. And he has to file the same way. They all have to match. So if one couple files married separate, both parties have to do that. It just can't be one of the, it's going to kick out for the other party that they filed married separate. This person filed single, even though they were now indicated as they're still married with another party. It can get very messy in those situations, but it's usually very clean. It's just people, they were married for a couple of years. They decided to go their separate ways. Maybe they're living in the same town, but they're not living in the same house. That's the trigger point there. Right? Married jointly. They're considered married jointly if on the last day of the year they are married and living together. They're married and living apart, but they're not separated or divorced. They've been separated under an interlocutory, which is a non-final divorce decree. They're living in a recognized common law marriage, which isn't in this state. If the spouse died in 2020, and the survivor can file jointly with the decedent if one of the 4 tests above are met, which most folks, if they had been filing married jointly, spouse passes away in 2020, you get that one final chance to file married jointly. Maybe you would want to file married separate. I don't see why that would make sense. But again, in this case, it's talking about married and living together. Again, living together is the main key. Again, in New Jersey, same-sex couples can file jointly if they were legally married in a jurisdiction that recognizes their marriage. New Jersey is one of those. They do not need to live in a state that recognizes same-sex marriages to qualify for filing joint status. Again, that's all federal. It's very clean now in New Jersey. New Jersey recognizes same-sex marriages at the state level. It's a little complicated for folks who are in states that don't. But again, we won't see that because Pennsylvania and New York are in the same boat as New Jersey. Married filing separate. Okay, taxpayers, they may file at the end of the year, they may elect to file separately. And the reasons are pretty much limited to basically they don't want joint liability. It's the situation of what's mine is mine and what's hers is hers. And they got married later in life, and that's just the way that they want it to be. That they're, and for a lot of folks in our income cohort, as long as there's no Schedule A deductions, because mostly they don't have it anyway, they're paying rent, and their incomes are roughly the same, it's kind of like no harm, no foul. There's not going to be a big penalty for filing married separate. Now, in limited circumstances, they may actually pay less, which is something we might see. Again, the one thing that they tend to do is if the one spouse came into the marriage with tax liability or child support issues, that's why in general, why they want to keep it. That's where they get the joint liability, which means the IRS can only, or the state can only hold part of the refund on the spouse with those obligations and not the other one. There are issues where, is there, could we do a innocent spouse kind of situation, injured spouse? Again, that is out of the VITA scope where that might help. There's just too much getting in the weeds on that. From my experience, most folks in these situations, excuse me, know full well what the financial obligations were of the other partner in their marriage. And so that whole idea of injured and innocent spouse is not going to fly with the IRS. Married filing separately, there's a lot of negative effects. It almost never makes sense for most people with children, because you lose access to the earned income credit, credit for the elderly, childcare, adoption credit, all the education credits. You can't do student loan interest, the savings bonds interest exclusion. You get you lose the standard deduction. A greater part of your Social Security is subject to tax. You're limited on your IRA deductions, a whole lot of things, which just makes no sense at all. The biggest thing is the child care credits and the earned income credits that you just don't get if you file married separate. Head of household, to qualify, the taxpayer must meet all of these. They must be a U.S. citizen or a resident for the entire year, not married at the end of the year, or is considered unmarried. Okay, the considered unmarried would be those folks that were technically still married, but now one party is out of the picture, and the other party has a qualifying child or a qualifying relative, pays more than 50% of the cost of keeping up the home, and that home was the principal residence for more than half of the year. So that is what we see a lot of. Again, the single parent, and that's what you get head of household. It's a much higher standard deduction. You qualify for the earned income credit and child tax credit, and that's what we see a lot of. Again, if the situation is where there's still someone living in the home, we had an individual come to United Way 2 years ago, and it was a husband and wife. They had 4 kids, and each one, they brought in their previous year's returns, which was nice because almost nobody does, even though we ask for it. But the problem with their return was it indicated that they had each filed, and they went to a paid preparer. They each filed head of household claiming 2 children, and their income was such that they got the max earned income credit and the max child tax credit. So between the 2 of them, they got like a refund of over $9,000, half of which they weren't entitled to. So in going through it, it's kind of like, I can't believe somebody, that's what some stuff happens out there. And they will probably get tripped up because they all had the same address. That's the biggest red flag. How could you have 2 heads of households sharing the same address? And they're married. So, that was a situation where we kind of brought that to their attention and let them know that, we'd be happy to amend it, and they would probably have to pay back quite a bit of money, or they could just wait for the probable letter from the IRS indicating that this was a problem, and we filed that year's correctly. Head of household, again, the taxpayer files, considered unmarried if the taxpayer files a separate return. They paid more than 50% of the cost of the home. The spouse did not live in the home during the last 6 months of the year. That's a tricky one too. If like during the year, if he went on a walkabout, or she, in February, we're good. If the spouse left, or the other parent left in December, we can't do head of household. We have seen that from time to time. Again, grandchildren are not part of this test. What we've seen over the past couple of years is, unfortunately, some grandmothers are now having full custody of their grandchildren because the custodial parent or parents are out of the picture. Either they're incarcerated, or they've just walked out. So the test there actually changes, so they can actually claim them as their own daughter because they've adopted them. So although they're biologically their grandchildren, they've gone through the process of adopting them. So now they get to claim the earned income credit, the child tax credits for the grandchildren. Again, the cost of keeping up a home, which really most of our folks are renters anyway. So the idea of taxes, mortgage expense, utilities, all this stuff is kind of like out the window. Things you can include are education expenses, clothing, medical expenses, vacation, transportation, and life insurance. The qualifying surviving spouse is basically a situation where there's a dependent child, which doesn't include grandchildren or foster children, after the spouse had died. So if the taxpayer's spouse died in 2020 or 2021, the taxpayer has entitled to joint return in the year the spouse died. If they didn't marry before 2023 and kept 50% or more of the cost of keeping their home, you get this for 2 more years to file. It's a different status, but the standard deduction is the same as if you're filing married jointly. Again, we don't really see much of that. And this is something which I won't spend a lot of time on, but I will, if any of you have any interest in taking the foreign student test. Occasionally we get folks coming in who are, they're on some sort of teaching kind of situation at Princeton or TCNJ or Rider. We generally don't get involved with non-resident alien returns with these types of visas, the FQ, FJ, M, or Q. It has to do with determination of their filing status, whether or not they're a resident or non-resident alien. It has to do with how many days they're here, how many years. It's very confusing. In fact, TaxWise does not even support a 1040 NR. We can do it by paper. We try and refer them back to the bursar's office or the student aid office at their various colleges. Again, these typically are students, refugees, teachers. Again, folks are here short term. There could be some undocumented immigrants involved. Try not to get involved with that as much as we can, because we try and focus on what we do best. And that part of that is those folks that are here, not on a temporary basis, but are attempting to be here permanently, is to get them a proper tax ID number. Ideally, most of our folks already have social security numbers, or they have gotten an ITIN, which is individual tax ID number. I've never seen an adoption tax ID number. Now, taxpayers who have the ITINs all start with a 9. And generally, if they worked and earned W-2 wages, you're going to see on the W-2 that the number is different than their ITIN. By nature, a W-2 cannot have a number that starts with a 9. It just doesn't work. You can't use the software. So what you do is there is a little button, and we'll get into that in TaxWise, which says the number is different than what's on the tax return. We put in the social. Now, the social is actually a social security number for somebody else. What it involves basically is folks who are working. We see this a lot with landscapers, with people who work in restaurants. The restaurant has a couple of social security numbers from past employees or current employees, and they assign that to that particular individual. That individual is earning those wages and paying the income tax on it. So at the end of the day, it seems sketchy, and sometimes it takes a little kind of working through it to understand how this all seems to be legit, but it is very much so. And we do see a fair amount of these. The interesting point is, after a number of years, hopefully, when the individual gets a social security number, that the credits that were earned on that social for Medicare and Social Security get transferred from the ITIN, from the old Social Security number to the taxpayer's new Social Security number. That's just something I picked up on a few years ago, which is kind of like, they get credit for the tax, but they could be earning wages for any number of years, and they're accumulating credits for Medicare and Social Security. Does that go? Do they not get that? But the answer is that they do. Now remember, folks with ITINs. Sorry. Folks with ITINs are not eligible for the advanced child tax credit. Dependents that have it. Now, if the dependent has it, they're basically not eligible for anything. But if the child has a social and parents have an ITIN, you can qualify for the child tax credit, but not the earned income credit. That's kind of an important thing to remember. And we'll be reviewing that when we go through the credits next week. That's pretty much it for the filing status and dependency. The other thing that I wanted to share with everybody is the new 1040. Okay, the 1040 was changed again this year. And that's that. Okay, so what you're going to see at the top is where it has the filing status. It's got the name, social, that's kind of the same. And then it says here, they've changed the last year in tax-wise, it said, did you trade in any kind of crypto? Now it says, did you receive as a reward, award, or payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset? Now, 99.9% of our clients, this isn't going to be a problem, but there's always some young folks out there that still, I guess, they're working from home and they're trading crypto on their Robinhood account. By now, most of these outfits are going to be providing 1099s. So we should be good for that. But again, we don't see a lot of that. But again, we have to ask that question. The big change is down here on page 1. So if you look at 1B, 1C, 1D, 1E, 1F, 1G, all of these, I don't know why these aren't somehow subtotaled on Schedule 1 or whatever, but household employee wages not reported on Form W-2, which is kind of like if you're paying cash to someone to clean your house and you're going to report it there. Nobody's going to do that. Tip income's another one. If sometimes tip income gets reported on a W-2 because that's how the restaurant operates. But again, no one's going to be reporting that. Medicare waiver payments not reported on a W-2. Medicare waiver payments involve folks who are taking care of a loved one, if you will, in a remote situation, and they're somehow being compensated one way or the other. Usually it is a W-2. So I don't know how a waiver payment would not be reported in any other way. But again, that's not something we're going to see. Taxable dependent care benefits, I believe this involves folks who have payroll deductions for dependent care, but have an excess amount withheld, which is then subject to income tax. Same thing with the adoption benefits. So none of that we're going to see. Other income, line H, this will be coming over from Schedule 1, which includes things like unemployment, jury duty, net earnings from a business, and a couple little odds and ends, minus any adjustments, which would be student loan interest, the educator benefit of $300 that teachers can deduct for classroom expenses, things like that. Here's the other thing that, again, when we get to lines 2, 3, 4, 5, and 6, I mean, that's our bread and butter stuff. Any kind of interest or dividends, again, we don't see a lot of that, but that's basic, basic stuff. IRA distributions, pensions, and of course, Social Security benefits. 6C, if you elect to use the lump sum election method for Social Security, check here. That would be if folks who have some sort of claim with Social Security that they're going to get it all, sometimes it takes a year or so they could get this big check all at once. Finally it catches up with them and they get a big check. Obviously that means more of it is subject to taxation, and you could elect to spread it out. Again, I don't know how you do that after the fact. Presumably you would have done that before you got the lump sum distribution. But again, that's not something we're going to see. Capital gains and losses, other income from Schedule 1, total income, standard deduction, taxable income. That's, so once you get to line 15, there's nothing you can really do. I mean, when you go to page 2, which is how the tax is automatically calculated, all these other credits come over from different schedules. The child tax credit, Schedule 3 is the other credits. And then you have the actual summation of what was paid to the IRS. Taxes from your W-2, from 1099. Other forms would be from like foreign tax credit, or I'm sorry, the tax collected on dividends if the broker kept it out, or a 1099-B. Then you get further down, there's your any estimated taxes, which again, our world, nobody pays estimated taxes, or amounts from the 2020. The earned income credit, the additional child tax credit, and the American Opportunity Credit. Add up all those, minus what they may or may not owe, and you get what their refund would be. Again, the routing and account numbers get put in. All this gets reviewed with the account. So again, that's what the new 1040 looks like. It's not a huge amount of change, but again, they're adding information that or lines that we certainly won't see, let alone most other folks. One thing that has come up recently, and let me just kind of get out of here. One thing that's become recently is the notion of the let's see. There we go. There's me. Hang on. There we go. One of the things is that's come up recently, I'm sure maybe you've seen some news on this, is the reporting of income by folks like Venmo and PayPal, that people who have more than $600 in those transactions will get a 1099-K. This is mainly as a way of trying to get folks who are in business for themselves, that they're reporting all their income. Basically, it's all these people that are in the gig economy that are doing better than our clients would. Again, all we generally see are Uber and Lyft drivers who all that income gets reported via Uber and Lyft. But again, I think this is meant to catch folks who are doing really, really well and been able to kind of like skirt the income rules for a while. There's talk that, again, if you use Venmo a lot, but you're not in a business and you get a 1099-K, what do you do with it? I don't really know yet. Will be interesting to see. I think that's more amongst ourselves than what our clients will see. But that's kind of something that's popped up recently. The other thing is folks are getting people who transact sports tickets, concert tickets online, are getting letters requesting their Social Security number. So if you've got Giant season tickets and you sell them through SeatGeek or StubHub, you're getting letters requesting your social security number, because now they're going to report the amount of money that you receive selling tickets. Obviously, it's not all profit. So how all that gets reconciled, who knows? But those are some other things that I think that they're out there, in trying to capture more income for folks that, again, the one person who has a couple of concert tickets that they sold is not the problem. The problem is like, who bought all those Taylor Swift tickets and are reselling them at, $1,000 a pop? Those are the folks that they want to hammer for taxable income. So again, we won't see any of that. Again, I'm pretty much done right now. I'm going to go ahead and stop the recording.